Hey everyone, welcome back to Corporate Decoder, the place where we break down complex financial documents and make them easy to understand. Today we're diving into GrabAGun Digital Holdings Inc.'s latest filing. And let's just say there's a lot to unpack as they officially complete a major business combination. This report is all about GrabAGun Digital Holdings Inc., completing what they call a business combination. Think of it like two companies joining forces, and this document is the official announcement outlining all the nitty-gritty details. It's like the marriage certificate for two corporations. So what exactly happened? Well, GrabAGun Digital Holdings Inc. officially combined forces with Columbia Acquisition Corp.do. This means that after all the paperwork and shareholder approvals, Columbia is now part of GrabAGun, and GrabAGun is the main company. They essentially merged, with GrabAGun becoming the surviving entity, and all of this happened on July 15th, 2025. This move is a big deal because it means GrabAGun, which was previously the operating business, is now the publicly traded company. The old Columbia entity, which was more like a financial vehicle, has essentially been absorbed. You'll see mentions of common stock with a very small par value, $0.000001 per share. This is just a technical detail for how the stock is valued on paper, but what's important is that this is the actual ownership stake in the new combined company. While the filing mentions their principal executive offices are in Coppell, Texas, that's not the main story here. What matters is the business combination that's being reported. GrabAGun's common stock got a new ticker symbol, PEW, and it's now trading on the New York Stock Exchange. This is a major step up for the company, giving them more visibility and access to capital markets. They also have warrants, which are like options to buy stock at a certain price. These are trading under the symbol PEW, also on the NYSE. The exercise price for these warrants is 11.50 cents. GrabAGun is also identifying itself as an emerging growth company. This means they benefit from some regulatory flexibility as they grow, allowing them to phase in certain reporting and compliance requirements. The whole process started back in January 2025 when the key agreements were signed. This document is essentially the final report confirming that everything that was planned in that business combination agreement has now been executed. On July 15th, the closing date, shareholders of Columbia had their special meeting where they voted to approve all aspects of this combination. The report details the voting results later on, so we'll get to that. Only shareholders who own stock by June 20th could vote on this deal. This is standard practice to ensure only existing owners have a say. The main events were two mergers. First, a subsidiary of the company merged with Columbia, making Columbia a subsidiary of GrabAGun. Then another subsidiary of GrabAGun itself, with GrabAGun itself publicly traded. As part of the deal, the former owners of GrabAGun received about 10 million shares of the new company stock and $50 million in cash. This is the primary compensation for them giving up their private company for a public one. The real trading action began the day after the closing, July 16th, with the ticker symbols PEW for the stock and PW for the warrants. This is when the company officially became a public entity accessible to all investors. So the old Columbia shares that weren't redeemed were converted into shares of the new GrabAGun company. If you held Columbia stock and didn't sell it, you now own a piece of GrabAGun. As mentioned, the GrabAGun internal shares were exchanged for that mix of cash and stock in the new public company. The filing also details how the money from Columbia's trust account was used. After paying off shareholders who cashed out their shares and covering deal costs, the remaining cash from that trust account, which was about $119 million, went to the company. This is typical for SPACs, where the trust account funds are used to finance the acquisition. There was also an important agreement about the warrants. GrabAGun took over all the rights and responsibilities related to Columbia's warrants. This ensures that the warrants are now tied to the new company, GrabAGun. They also set up an agreement with an exchange agent. This is the company that handles the actual distribution of the cash and stock to the old GrabAGun owners. It's the logistical backbone of the deal. A registration rights agreement was also updated. This agreement basically gives certain shareholders, like the original sponsors and GrabAGun members, the right to have their shares registered for public sale. This is important for liquidity, allowing these major shareholders to sell their stock in the future. Key executives like Mark Namati, Matthew Vidito, and Justin C. Hilty have entered into new employment agreements. They are also signing on with restrictive covenants, which usually means they agree not to compete or poach employees once they leave. These agreements are standard for new leadership in a public company. The company also made sure its directors and officers are protected. Indemnification agreements mean the company will cover their legal costs if they get sued for actions taken as a director or officer. It's a way to attract and retain talent in leadership. There was also an amendment to a letter agreement that affects when major insiders can sell their shares. This is a lockup period. It was revised so that the lockup ends either 6 months after the closing or when the stock price hits $15 for 20 days within a 30-day period. This is designed to prevent a flood of selling that could depress the stock price early on. Let's look at the shareholder structure after the deal. Almost 21.2 million shares went to the original Colombier shareholders who didn't cash out. Another 10 million shares of GrabAGun's common stock. Outstanding capital after all this, there are about 31.5 million shares of GrabAGun's common stock outstanding. It also tells us how many people cashed out their shares. About 4,732 Colombia shareholders redeemed their shares, getting around 10.63 cents per share back from the trust account. This means about 50,290 was paid out to these redeeming shareholders. Because the company that was acquired, GrabAGun, wasn't a public company before, and the SPAC Colombier was basically a shell company with minimal operations. This filing needs to include information as if GrabAGun were filing for its own public offering on a Form 10. This gives investors a comprehensive understanding of the actual business of GrabAGun. As expected in these reports, there are a lot of forward-looking statements. These are basically statements about what the company expects to happen in the future. Things like anticipated financial performance, plans for growth, and the potential benefits of the business combination. The company wisely includes a disclaimer that these are just expectations and the actual results could be very different due to various risks and uncertainties. Some of the risks they highlight include changes in their competitive landscape. This is a common concern for any business, especially in fast-moving markets. Another key risk is their ability to actually execute their plans and seize opportunities. Having great ideas is one thing, but making them happen is another. They also mention risks related to supply chain issues and keeping up with new products or market trends. If they can't get their products or keep their offerings fresh, they could fall behind. The filing refers back to the proxy statement for details about GrabAGun's business. Essentially, GrabAGun.com is an online retailer for firearms and related accessories. Think of it as a major e-commerce platform in that specific niche. Now let's look at who owns the company after this deal. Mark Nemati, one of the executives, owns about 2.5 million shares, which is close to 8% of the company. Matthew Viditao, another executive, also holds around 2.5 million shares, again close to 8%. Justin C. Hilty, the third executive, also owns roughly 2.5 million shares, also around 8%. Altogether, the executive officers and directors own about 7.9 million shares, which is about 25% of the company. This shows significant insider ownership, which can be a good sign if management is aligned with shareholders. Brent Cozzi is also listed as a major shareholder, owning about 2.5 million shares, which puts him at roughly 7.93% of the company. As for dividends, the company hasn't paid any yet. They mention that the board will decide on dividends in the future, but they don't expect to pay them for the foreseeable future. So investors looking for income from dividends might need to look elsewhere for now. The company's formation documents were also changed. The authorized number of shares was increased to 2110 million. This gives them flexibility to issue more stock in the future if needed for acquisitions or other corporate purposes. They've also appointed a new auditor, Weaver and Tidwell LLL. He will be handling the audit for the upcoming year. Prior to this, Witham Smith plus Brown PC was their auditor. This is pretty standard when companies go through a merger. This section confirms that yes, there has been a change of control. The business combination effectively transferred control to the shareholders of GrabAGun. Here's where we see how the shareholders actually voted. It's a detailed breakdown of each proposal presented at the special meeting. The business combination itself was approved with an overwhelming majority of over 9.8 million votes in favor. This shows strong shareholder support for the deal. Even the insider letter amendments, which dealt with lockup periods, passed with a similar level of support, indicating that even the more nuanced agreements had shareholder backing. The filing concludes with a list of all the exhibits filed, which includes the business combination agreement, amended formation documents, employment agreements, and more. These are the legal building blocks that support everything announced in this report. The business combination agreement itself is listed here as Exhibit 2.1. This is the foundational document that laid out the terms of the entire transaction. And you can see the employment agreement for Mark Namati listed as Exhibit 10.6 and similar agreements for the other executives. These are the specific contracts that solidify leadership roles post-combination. The exchange and paying agent agreement is also listed here. This is the document that details how the money for the deal is actually moved around and distributed. From a business perspective, GrabAGun operates in the firearms and accessories market primarily through its e-commerce platform, GrabAGun.com. This market can be quite competitive and is also subject to significant regulatory scrutiny due to the nature of its products. The risks they've highlighted, like competition and keeping up with market innovations, are very real. The success of this business combination will hinge on GrabAGun's ability to leverage its new public status to grow its market share and manage its operations efficiently, especially given the sensitivity of its industry. In conclusion, GrabAGun has made a significant leap by going public. The combination seems to have gone smoothly based on the shareholder votes. The company is publicly traded, has new leadership agreements in place, and has addressed the critical logistics of the merger. The next steps will be all about executing their business plan and demonstrating their value to public investors. Alright, that's our breakdown of this GrabAGun Digital Holdings Inc. filing. What's your take on this business combination and what it means for the company's future? Let us know in the comments below. If you found this analysis helpful, give this video a thumbs up and don't forget to subscribe for more discussions. Thanks for watching and we'll see you in the next one.